Hey everyone, welcome back to another Bitcoin and cryptocurrency video. In today's video, we will be discussing the most up-to-date CPI report and inflation. If you like this type of content, make sure you hit that like button, make sure you hit that subscribe button as it means a lot to me. And if you are a fan of cryptocurrency, I have a cryptocurrency shop where you can shop cryptocurrency products. I'll leave a link in the description down below so you can get a nice discount off your next purchase. So without a further ado, let's begin. Live updates. CPI report, inflation comes in hot, dashing hopes for Fed rate cuts. Significant data coming in today, significant data, because inflation came in at 3.5%, hotter than expected. Yeah, the data came in and it was higher than what the Fed was expecting. So what does that mean and how does that relate to Bitcoin, cryptocurrency, and the prices of the asset class? So let's begin with the data coming in at 3.5%. It is a change of 0.3% from the previous month, and it is sitting at 3.5% year over year. Why is that important? Well, it is very important because since June of 2023, the inflation rate has essentially been in an uptrend. So we can categorically class that as sticky. Inflation is essentially sticky. It's being stubborn because ultimately the Fed's target of inflation is 2%. The Fed want to get to this level right here. They want to get to 2%. That is their target of inflation. Because 2% year over year is great because it doesn't affect the general populace with regards to the price of goods and services increasing. 2% is a good margin year over year. At the same time, inflation is sticky. Sticky at 3.5% and putting in higher lows since June of 2023. I've said this in previous videos, and I'm going to say it again, and I'm going to say it in each and every single inflation video that I do. Yes, it was fairly easy for the Fed to bring down inflation from 9% all the way down to 3%. That is easy. Going from 9% to 3% is easy. The hard part is getting inflation from 3% to 2%. It is that last corner, it is that last mile, it is that last essential percentage bracket that it is much difficult for the Fed to bring inflation down from 3% to 2%. So, now that inflation is deemed as sticky, what does that mean? It means that the Fed need to keep interest rates higher for longer. The reason why this report is suggesting that inflation coming in hot dashes hopes for Fed rate cuts is because the Fed was expected to cut rates in June. Yesterday, when looking at this probability chart, yesterday it was highly probable that the Fed will likely cut rates in June. That would have been the first rate cut. But looking at it today, especially when the hotter than expected inflation data coming in, the Fed isn't expected to cut rates until September. So from June to September is a 3-month jump just because inflation came in hotter than expected. So why is that? It is important to understand the fundamentals of macroeconomics when it comes to investing, because you need to know how this data factors in to the pricing of the asset class, and we're going to discuss how it affects Bitcoin and cryptocurrency just soon. But to understand the fundamentals of macro data, when looking at inflation, when looking at interest rates, and when looking at the unemployment rate, they all go hand in hand with each other. So, for example, if inflation is sky high, the Fed will likely raise rates to bring inflation under control. And inflation, as mentioned earlier, has gone from 9% to 3%. Hence why the general populace were expecting the Fed to cut rates soon, because from 9% to 3% is a 6% jump, and 3% to 2%, yes, it is much harder, but we are closer to 2% than we were back at 9%. So the Fed isn't going to keep interest rates higher for longer. They will likely soon cut. With that being said, as inflation is now sticky and it is essentially putting in higher lows since June of 2023, the Fed is essentially going to keep interest rates higher for longer. Now, what does that mean? Well, when the Fed keeps rates higher for longer, they are doing that because they want to bring inflation down to its target of 2%, which is what we mentioned earlier. And as inflation is actually increasing and it is coming in hotter than expected, it is difficult for the Federal Reserve to essentially cut rates because they want to avoid the risk of re-acceleration of inflation to the point where inflation has a second wave of high inflation. The Fed wants to completely avoid this scenario because the Fed has essentially gone through this before. If we just take a look in past history, where there have been multiple waves of secondary inflations, we can see in the 70s where inflation soared, it came back down, but the Fed couldn't keep it under control. And because they couldn't keep it under control and they cut rates too soon, inflation re-accelerated. And the Fed essentially wants to avoid that same scenario where they've had high inflation, which was this moment right here. They've raised rates to the point where inflation has significantly dropped, but not towards their target. The mistake they made last time is that they cut rates too early. Now they are leaving rates higher for longer because they want to avoid the re-acceleration of inflation and they want to come back down to their target of 2%. Now that you have got that, that is when the unemployment rate comes in, and this is where it gets tricky. And I can sympathize with those who work for the Fed, even though I don't agree with their ideologies. I do sympathize with what they have to do because it is very difficult. Because the unemployment rate does play a heavy factor with regards to interest rates as well. For example, if the unemployment rate starts to go high, and if we take a look at the unemployment rate, the unemployment rate is also in an uptrend, bear in mind. Yeah, so this is where the macro data is going to start to get interesting, especially over these summer months. The unemployment rate is in an uptrend. Inflation is in an uptrend, and rates are higher for longer. So, when it comes to the unemployment rate, if the unemployment rate starts to shoot up high, the Fed has no choice but to cut rates regardless of what the inflation data is. Why is that? Because the Fed cares more about those who are unemployed than just essentially inflation going up. Yeah, the Fed would rather keep the workforce employed rather than inflation going absolutely berserk. That's just how it is. So the Fed's in a predicament now because if they leave rates higher for longer, that is more than likely going to mean that, yes, inflation will essentially look to come back down to their target of 2%, but they run the risk of the unemployment rate going up, and it has currently been in an uptrend. If the unemployment rate starts to shoot up, the Fed will be forced to cut rates, but with that being said, inflation will then go higher. Do you understand why it's such a sticky situation and why it's a scenario you can sympathize with those who work for the Federal Reserve? Because it's not easy. The Federal Reserve essentially wants a soft landing, but there's only been a couple of times in prior history where we have gotten that soft landing. Everything needs to fall in line perfectly for there to be a soft landing. More often than not, there is a hard landing because when you have interest rates higher for longer, the liquidity is just drained to the point where the economy, the businesses, the companies, the people, they cannot take high interest rates anymore. So the whole economy just collapses and caves in on itself. And that is when the unemployment rate starts to hike dramatically at the same time. So then the Federal Reserve need to then pump money back into the system to be able to get unemployment rate back down in order to essentially get interest rates back down. But then that comes at the expense of inflation going up again. So that is where we are with the current macro data at the moment. How does this relate to the price of Bitcoin and the asset class? Well, if inflation is high, if interest rates are high for longer, and the unemployment rate is starting to tick up, with regards to the Bitcoin price, no one exactly knows where Bitcoin will keep going towards. No one knows, because at the end of the day, it's a market, and we don't know where the price of Bitcoin will go. It can go up, it can go down within these macro conditions. We know that Bitcoin is a very sensitive asset, and it can react to news dramatically to the upside and to the downside, hence its volatility. So I'm not paying too much attention to Bitcoin USD when it comes to macro data. When it comes to macro data, I am more concerned about the Bitcoin dominance. And why am I more concerned about the Bitcoin dominance than Bitcoin price? As mentioned, price, we never know what can happen within the next few hours, within the next few days, within the next few weeks, and within the next few months. But we do know that when it comes to macro data, it is much easier to predict where the Bitcoin dominance will go rather than Bitcoin USD will go. And why is that? Because if liquidity is leaving the Federal Reserve and the Federal Reserve are reducing the size of their balance sheet, that means liquidity is getting drained from the system. And if liquidity is getting drained from the system, that essentially means that liquidity is flowing from high risk assets into low risk assets, because there's just not that liquidity to feed those higher risk plays. Now, to put that into perspective of the cryptocurrency asset class, liquidity is leaving high risk altcoins and they're going into the low risk cryptocurrencies, and the lowest risk cryptocurrency out there is Bitcoin. Bitcoin is number one. Bitcoin is the king. Bitcoin is the safest cryptocurrency out there. So liquidity is leaving high risk altcoins and it's making its way back into Bitcoin. Hence why ever since this rate hiking cycle began, the Bitcoin dominance has been in a significant uptrend, and I believe it will continue to be in an uptrend as long as the Fed keeps rates higher for longer. So that is where I am with the Bitcoin dominance. Liquidity is leaving altcoins and it is flowing into the king, number one, Bitcoin. And as long as the Fed keeps interest rates higher for longer, as long as the liquidity keeps getting drained from the Fed's balance sheet, liquidity from altcoins will go into Bitcoin, and that means the Bitcoin dominance will keep going up. So what I'm suggesting is that holding Bitcoin is the safest, because as I mentioned before, we do not know where Bitcoin USD will go in the short term or medium term. Long term, yes, you can assume that Bitcoin USD will go in an uptrend for its integrity of a lifetime. However, we do not know where Bitcoin USD will go in the short term or in the medium term. It can have a crash today, it can have a crash tomorrow, it can have a crash next week, it can pump today, it can pump tomorrow, it can pump next week. No one knows where the price of Bitcoin USD will go in the short term. But when it comes to macro data, you can easily identify where the Bitcoin dominance will go, because we know that as liquidity is leaving the Federal Reserve's balance sheet, the same applies to cryptocurrency, where the liquidity is leaving altcoins and it is flowing into Bitcoin, and it will continue to do so as interest rates are higher for longer. Hence why I am of the opinion that the Bitcoin dominance will continue to rise. I will be making a Bitcoin dominance video in depth in the near term future. I'll be analyzing the Bitcoin dominance, Ether Bitcoin, and altcoins against their Bitcoin pairing. So that will be another interesting video. But the macro data is interesting, guys. You know, this data coming in is quite sticky. Who knows what can happen, especially now that the unemployment rate is starting to rise, inflation is coming in hotter than expected, and interest rates are staying higher for longer. So yeah, I guess we just have to wait and see how this all plays out. But as I said, when it relates to Bitcoin and cryptocurrency, it just essentially means that liquidity is leaving the high risk altcoins and going into the low risk plays such as Bitcoin. So that is it from me today, guys. I hope you all enjoyed the video. If you did, smash that thumbs up, smash that subscribe button, and as always, it's been your boy J1 General. Thank you and goodbye.